Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Martin Armstrong created the economic confidence model. He founded Princeton Economics, and he wrote The Greatest Bull Market in History. Stay up to date with Martin at armstrongeconomics.com. Hey, Martin, welcome back to This Week in Money.
Oh, it's always nice to be back.
You are at the Liberty Mastermind Symposium. That's coming up in Dallas next weekend. A lot of our friends are going to be there. Bill Murphy, David Morgan, Jeff Berwick, John Rubino, Jay Taylor, they're going to be there. You can find out more at libertymastermind.us. Liberty, of course, on our minds a lot these days, Martin. We're finding out from folks like the NSA just how fragile it is. Looks like an interesting event. What are you doing there? What's going on there?
Well, primarily, it looks like I think everybody, I've been kind of what they call maybe the anti-gold type guy, but I just look at this thing, everything is connected, and you can't get gold going screaming up, through the ceiling without everything else in line as well. And this is, I think, our primary problem, that with, the Fed trying to manage the economy and Congress, etc., they act as if they're in control of something, and they're not. It's a global economy. Capital rushes around, and they really have to look at this thing and stop this interventionism. And this is the big problem. What we have today with the markets and, Obama coming out and basically, some people say he effectively fired Bernanke on PBS, but essentially they don't really know what they're doing. And I mean, I screamed bloody murder over the QE1 and QE2 and said it's not going to work. You people are just brain dead. That you're buying in treasuries, and the assumption is you're putting money into the system. And this is where I think sometimes the people that have been advocating gold don't get it. It's a global porous economy. And sure, you can, take in $3 trillion and, you're increasing the money supply, but that's assuming it's a fishbowl domestic economy. And what China did, they said, thank you very much, and they basically lowered the maturity on their debt and sold a lot of 30s and moved into, 5 years or less.
Mm-hmm.
So it's a global economy, not domestic.
Yeah.
And so this is why QE3, the Fed moved to buying mortgage-backed securities, and essentially you have rates going up today because at least maybe my screaming down in Washington on the Hill is starting to crack some heads down there. But effectively, Bernanke said that if he's going to sell anything, it's going to be treasuries and not mortgage-backed. Yeah. And so you have interest rates starting to move up. Now, your initial reaction is gold could still press lower. Your major support's just under 1,000, in the mid 900 range. But we need the interest rates to start rising in order to create inflation. Without that, all we have is massive deflation on a global scale. And it has nothing to do with the amount of money that the Fed has created. It is the fact that they are going absolutely crazy globally after taxes. And this is part of the reason why liquidity is down dramatically. It's still on a global scale about 50% of 2007 levels. So if you're, it's basically raising taxes sharply, you're hunting everybody that can possibly have any money, then people start hoarding. They don't invest, they don't create jobs, and the economy keeps spiraling down. You have China starting to back off a little bit now in the economic growth. You have Europe heading into an absolute, danger zone of perpetual economic collapse that will probably last at least another 5 years. Germany starting to turn down. The last economy that's doing any good is the U.S., and we are largely will start turning down I would say, by mid-2015 and then going into 2020, and that's what the economic confidence model is about. That will be the next major turn. And that is essentially the business cycle. And what people have to realize is that most of your academics and politicians wanted to say that the business cycle doesn't exist.
Okay.
And right on our site, Paul Volcker came out with a book in 1979, and basically he said, it's called, Rediscovery of the Business Cycle. That all the theories of intervention and we're going to manipulate interest rates and this to create the perfectly smooth, perpetual economy without any recessions just failed. It's the same thing as communism. It's centralized planning, and you're expecting somebody in government to actually understand what they're doing, and they don't.
Didn't they used to call this, the Soviets used to call this the command economy, right?
Yeah.
Yeah.
We're no different.
Yeah.
And communism, the whole Marxist thing, if it's communist or socialist, the core of it is government intervention, and the government can manage everything. And consequently, it is centralized planning. And communism began to fail in 1989. We are now starting to experience the same problem socially. And this is why you have unemployment rising dramatically. And the politicians are honestly living in some sort of time warp or something. They don't understand how to run an economy. Most of them are lawyers. And they may know how to write laws and expect people to obey them, but they have no clue as to what to do with the economy.
Martin Armstrong, our guest here on This Week in Money. Martin, you mentioned a turning point in the economic confidence model. That's coming up in August. What is the economic confidence model for our friends who haven't heard about it before, and how's it holding up?
Well, it is basically, it's the business cycle, which even Paul Volcker, everybody has admitted, is about 8 years. And it works amazingly. It hasn't been wrong yet. It just turns every time. And sometimes we're even right to the day. So it's essentially a global business cycle. And capital will invest in different areas and expand, and then it moves around. It doesn't stay in one thing all the time. So it makes some money in stocks, then it moves to commodities, then it moves to bonds, it moves to real estate, and it comes all around, goes through every sector, and eventually it gets back and starts all over again.
So what happens in August?
August is a mid-turning point, and we should basically see readjustments and reassessments here. So there's a possibility. A lot of things are starting to hover around this turning point, which is August 7th. We have the German elections in September. Gold, there's at least a shot that if we can close below, I would say, about 1230 on a weekly basis, then we can get maybe a complete wash out, clean it out and establish the predominant low. Gold is probably not going to take off again, I would say, until maybe about 2015, 2016. But it should base. 90% of your decline in any market is typically within the first 2 to 3 years.
Okay.
So the bulk of any decline would be now, and we would then get a bounce, and then it would probably most likely go back down to retest the lows. If it made a new low, it wouldn't be that drastic below what we created this time. For example, gold fell from 1980 into 1982, rallied into 83, went back down into 85. But the 85 low is $10 under that of 1982. So you're not looking at an extended decline that's going to, dribble down for years and years and years. But I would say we have a good shot of making the predominant low in the metals here this summer, and then begin to turn after the economic confidence model turns. But the real thing you're going to have to pay attention to, honestly, is going to be the German elections in September.
Okay.
The euro is, I don't even know what to call it anymore. Everything that was supposed to be behind the euro has been abandoned and vacated. It was that, they promised there'd be never any defaults, and so everybody went and bought Greek bonds and whatever because they were all going to be guaranteed. They find out that's not true. It was the purpose of creating a single economy, and now, Brussels has said, well, anybody who wants to put up their borders again to stop all the people running around for civil unrest, you can do that. So, it's like Europe is turning back to what it was, except they have a single currency.
You've set a target for the euro, Marty, under 80, and pretty makes a good sense of call here. You're saying the U.S. dollar is really becoming the only game in town.
Yeah, people don't understand that. But the euro could not ever be a reserve currency because there was no single national debt. That would be the euro would be the equivalent of if we had no national debt in the United States and banks could use all the debt of the various 50 states for their reserves. Who has the best portfolio? Nobody knows.
Yeah.
That's the way Europe is. It's an absolute basket case. You have Britain looking to move out. The whole thing is just crazy.
Yeah.
The politicians, instead of us just saying, look, we got it wrong, they won't do that. And they're holding on desperately to this idea, but the only way you could have had a single currency was with a single national debt. And until you accomplish that, there's no way. So there's nothing else in the world where huge capital can park. That's, yes, we have a national debt of $17 trillion. Okay. But that's a $17 trillion bond market that capital can hide in. There's no place to go. And you have institutions with $10, $15 billion. Okay, fine. Where do you put it? Can you, can you call up and say, well, give me a market in Greek bonds or Spanish? Where do you put the money?
Yeah.
So a lot of it has been going into the equities back again, which is why the Dow made new highs. But it will back off, but it's going to go up again, and largely because you have no place to go. Mm-hmm. And this is the issue with the dollar. And until we see Europe crack, and then that's going to push the dollar up very high. Japan, also a basket case. China, not a quite free market yet. So there's no place to go with this money.
Yeah.
As the dollar goes up extremely high, then we're going to see our recession begin. That creates even more deflation, etc. Unemployment will start rising even more. And what we have at this stage in the game is spring-loaded interest rates. Because effectively, the downside of all this buying and by the Fed and manipulating interest rates to such a low level, the problem is that if they start to rise, now you get into an exponential level of national debt taking off. Mm-hmm. And that's the real crisis with the dollar, is that so many people have loans globally in dollars because the interest rates were cheap. And so you have the biggest short position probably of anything in history is dollars. And so people will then have to cover those short trades, and that pushes the dollar up even higher.
Martin Armstrong created the economic confidence model. He founded Princeton Economics, and he wrote The Greatest Bull Market in History. Follow Martin online at armstrongeconomics.com. Don't forget, Martin's at the Liberty Mastermind Symposium in Dallas. Coming up next weekend, you can get more information at libertymastermind.us. Martin, always a pleasure to talk to you, my friend. Thank you.
No problem. Great to be here.
This Week in Money is archived online at talkdigitalnetwork.com.
John Rubino is co-author of The Collapse of the Dollar and How to Profit from It. Visit John's website, dollarcollapse.com. It is, and always will be, your ringside seat for the global financial crisis. Hey, John, it's good to have you back here on This Week in Money.
Hey, Phil. It's good to be back.
Ben Bernanke press conference this week. Bernanke says the Fed will scale back its QE program sometime later this year, may wind it down sometime next year, and he wants the market to focus on the health of the U.S. economy, not what the Fed is doing. Yeah, good luck with that.
That didn't quite work, did it?
No.
This was always about when QE stops, because we know that the government has an unlimited printing press. They can shovel money out into the economy and make things happen. But the question is, can they cut the addict off without it going into massive withdrawal symptoms? And it looks like they can't.
Yeah.
The market's just getting a whiff of the possibility in the intermediate future that the government might consider easing back marginally on the government, the money that they're pumping out, sent the markets into a cardiac arrest. And so that implies, and meanwhile, the economy really isn't growing. We've got financial crises all over the world springing up right now. China has some kind of a liquidity crisis. Europe is dropping into a deeper recession, and the U.S. is growing only marginally, and a lot of that is due to us, miscalculating, to be charitable, the inflation rate with which we deflate GDP growth. So, despite several years of the most massive debt monetization in human history, we aren't in the middle of a global boom right now.
It seems
the global economy is not growing very quickly, and to cut that off terrifies everybody, because the only reason asset prices are as high as they are is because of all this liquidity coming in. You take that away, stock prices tank, house prices tank, and we drop back down into a 1930s style depression or a 2009 style crisis. Something bad happened.
It seems, John, that all they've really done is manage to make this worse. And I'm being charitable to Bernanke here, but I'm sure he must be scratching his head, wondering what the heck to do next.
Well, they're in a box. All the big central banks are in a box that is derived from the fact that they allowed the system to take on too much debt in the first place. Yeah. Now the only near-term solution is to pump out huge amounts of money and buy back a lot of that debt. But that's just a temporary solution. That just keeps the system going on life support. It doesn't actually fix anything structurally. So the minute they try to stop, everything falls apart, and they know that. So I think a lot of these guys are they've got their retirements in sight, and that's the prize that they have their eyes on. And so they're just trying to get the system through to the point where they can leave with a little bit of prestige and then leave the mess for their successors.
Yeah.
And, Bernanke here is leaving in another year, it sounds like. And so I think his main goal, I think he recognizes that this is not fixable, and that his main goal is just to get out with his reputation intact. And then whatever happens after that, so be it.
Let's review, John, what happened this week. Wall Street, its biggest one-day drop in a year and a half. Emerging markets tank, bond yields soar, gold falls 5%, all on the strength of what Bernanke did or did not say. How did we get to this point?
Well, we got to this point by borrowing too much money. And, the basic thesis of the dollarcollapse.com and most of the work that I've been doing for the last few years is that debt works the same way for a country as it does for an individual or a family, which is to say if you borrow too much money, bad things happen to you. And we are firmly in the bad things phase now. After 30 years of an unprecedented credit boom in which we borrowed more and more money every year and lived really well with all that borrowed money, and now we're having to pay the cost of it. And just like a family that bought a big house and an SUV and took nice vacations on their credit cards, we have to find a way to suddenly live within our means and cover the debts that we've accumulated in the past. And there's no way we can do it.
Yeah.
The numbers just don't work. So we have some kind of a crisis on our hands. And we got a taste of it this past week when the government tried to turn off the spigot. And as you said, every single market out there tanked. The dollar was the only thing that didn't tank, and that's only because everything else was even in worse shape than the U.S. is perceived to be. But that's an illusion. We are in just as bad a shape as anybody else, and just as unable to turn off the easy money spigot. And if our interest rates go up just a little bit further, that'll shut down the U.S. housing market, that'll tank the stock market, and that will start interest costs that the government has to pay when it rolls over its debt ratcheting up, which will make the deficit start expanding again. So everything will go haywire if we try to scale back QE and allow interest rates to go up. And if we don't, if we continue to buy back huge amounts of bonds and funnel huge amounts of newly created currency into the banking system, then we get asset bubbles like we're beginning there. The stock market was at an all-time high in the U.S. The housing market in a lot of different parts of the U.S. are back to 2007 levels of speculation and pricing. And to let that go on much longer, you become destabilized by all the malinvestment that comes from financial bubbles. So we can't win. and the only question is what kind of loss do we choose? Do we collapse under the weight of all our debt, or do we inflate it away? And that's it. That's it for us.
I guess option B probably the most logical one, even though not the best one.
Well, option B is the least painful in the short run.
Yeah.
Which is the way that elected officials think. If you can get through the next 6 months, then something good might happen. You might get bailed out by some miracle or some unforeseen positive event. So, of course, try to get through the next 6 months without a collapse. And that means pump more money into the system and try to elevate asset prices. We've had a thing called the wealth effect operating in the U.S., at least according to the government's plan, where you pump out a lot of new money. It makes asset prices go up. Stocks and houses go up in value. It makes people feel richer. Then they spend money and borrow money, and the economy starts growing. And the hope was that it would kickstart the economy and start it growing on its own, so it doesn't need government life support. But we found out that's not the case. That the minute you take the life support away, the asset bubbles burst. So here we are,
now,
the inevitable outcome of too much money.
Now, you've mentioned earlier that the U.S. recovery pretty much an illusion. Wondering what will happen to that recovery once the Fed really decides to come down hard and stop pumping QE, or are they just simply going to reverse course?
Well, my guess is that they'll be panicked by what has happened this week, and that if it continues, if we have another couple of bad days in the stock market, or housing looks like it's rolling over because mortgage rates have spiked, or the bond market is going haywire as it has this week, but if that goes on for another few days, then I would guess that they would come back out and take it back about tapering. Yeah. And they would say, look, don't worry, QE will go on as long as it takes. We'll keep interest rates down. We'll keep buying back bonds. We will do what it takes. Don't worry. Okay. And so then we get the other side of that equation. We get the asset bubbles blowing back up again, or some other asset bubble blowing back up, or a currency crisis in which nobody wants to hold dollars, or something. We get some other part of the pressure cooker leaking steam, and nothing will be fixed. We'll just shift from crisis to crisis until there's a confluence of crises, like what started to happen out there. The emerging markets tanking, especially with China, and Brazil seeing millions of people in the streets rioting right now. These are fairly serious events that aren't really on our radar screen yet, but let them be combined with trouble in the U.S. bond market, and Greece is starting to blow back up again in Europe, and France is dropping into a what looks like a depression, and Spain has never come out of it. Let a few of these things show up on the front pages at the same time, and then that'll panic everybody, and then maybe that's the end of the process. I don't know.
John Rubino with us here on This Week in Money, and a great quote here from a Canadian commentator and frequent guest here, Garth Turner. The era of dirt cheap money is shuttering to a conclusion. He says that's what all the market turmoil has been about this week.
Yeah, We're addicted to incredibly cheap money. I think people have gotten used to interest rates being this low, and they don't realize how historically unique it is to have mortgages at 3% and change in the U.S., and to have savings account yielding nothing, basically, and to be able to borrow on margin to buy stocks for probably the least that you've ever had to pay for something like that. These are historically unique interest rates, and they can't go on forever. But now that people are used to them, they're panicked by the idea of them not persisting. So let it end, and we have some kind of turmoil. It's not clear what kind. Could be many different things go wrong, but something big will happen.
What about the fate of the U.S. dollar? It is strong today. The dollar index up more than 3% since the year kicked off. Where are we looking with the U.S. dollar going forward? Any bad news coming up on the horizon there?
Well, the fundamentals of the U.S. dollar are horrendous. We continue to accumulate more and more debt, especially if you calculate U.S. debt according to GAAP accounting rules, generally accepted accounting principles. Our deficit accounted for that way is about $6 trillion a year and not shrinking. And so the underlying fundamentals of the dollar, if you were just standing back looking at our numbers, you would say this has got to be an extremely weak currency.
Yeah.
The fundamentals are terrible. And so once we're perceived to be also problematic, instead of just slightly better than China, therefore you invest in dollars, slightly better than France, when we're perceived to be in that group and with our own problems, then the dollar won't necessarily go down against these other currencies because the other currencies are going to continue to be pretty crappy, but it'll start going down against real assets. You'll see a spike in hard assets that is really a drop in the value of the dollar, the unit against which we're measuring oil and gold and silver and things like that in farmland. And that'll be the signal that maybe the tide is turning for the dollar.
You're asking a fascinating question here, John, on your Dollar Collapse blog, saying it's time to think about the next big government plan to save us. Wondering, is it going to be public works? Is it going to be more QE? Or maybe even something we've talked about before, a war?
Yeah, well, false flag type wars have been a pretty common occurrence throughout history. And when a government gets into trouble at home, they try to distract the populace by creating an enemy abroad. And I hate to think about that.
Yeah.
But it's got to be something that's on the radar screen of somebody who's watching this world and wondering what's going to happen next. And another possibility now is some kind of coordinated global quantitative easing, because you've got a lot of countries who are kind of sinking into the abyss at the same time here. And let China and Europe and the U.S. all start to roll over at the same time, which we all kind of are, then it wouldn't be a surprise for these guys to get together and say, all right, look, we'll just coordinate it. We'll do it together. We'll name some gigantic number, and we'll just blow the market away with how much we're willing to liquefy out there. And that would be the next stage, because we've gotten progressively bigger over the last few years, and it's not clear how effective an individual country just naming a bigger number and pumping out even more currency, it's not clear how that would help anything, because the numbers are already astronomical. They're already beyond the scope of the human mind to grasp.
Yeah.
So, $5 trillion instead of $3 trillion, would we care? I don't know. But $20 trillion by 5 different countries, that might get our attention.
What's going to happen next week? Are we going to see Bernanke pull back? Or are we going to see more mayhem in the markets? What do you think?
Oh, I have given up trying to figure out what happens even day to day or week to week, because this is just such a crazy time. Mm-hmm. Who would have expected this week to happen?
Nobody.
For the week before, especially in, for instance, precious metals. I mean, the gold and silver action has caught gold bugs completely off guard. And the action in the stock market of this past week caught all the optimistic people off guard, the people who were buying stocks on margin for the last month or two. So what happens next week is absolutely anybody's guess. And the only thing I would say is that because the underlying fundamentals are bad, the tendency going forward is for the news to be kind of chaotic and unexpected and dark, just because we've created the conditions in which that's the dominant theme of the world right now.
hang on, it's going to be a crazy ride.
Oh, yeah, absolutely. The next few years will just be worthy of entire chapters in history books that they write 50 years from now.
And you and I will follow it as we go along.
From a safe distance, right, Bill?
John Rubino is co-author of The Collapse of the Dollar and How to Profit from It. You can find John online at dollarcollapse.com. Hey, John, appreciate you talking to us today. Thank you, sir.
Oh, sure, Phil. Thanks.
This Week in Money is archived online at talkdigitalnetwork.com.
Keith Schaefer is our go-to guy for oil and gas on This Week in Money. He's online at oilandgas-investments.com. Hey, Keith, it's good to have you back.
Phil, great to be here.
Big natural gas news today. Front page headline, Keith, in the Vancouver Sun. Exxon joins LNG race in BC. Exxon Mobil, the world's largest energy company, planning to export 30 million tons of LNG a year from BC. I guess the big question is, when?
Well, it's interesting. We're going to see two dates that are really going to be important. One is only 2 years from now. In early 2015, the smallest of the proposals should be in production and shipping gas. And that's the one that's joint ventured with First Nations and includes a shipper called Golar.
Golar. Okay.
And they're listed on the NASDAQ. And so what these guys have done is they're normally an LNG shipper, but now they're vertically integrating. So they've got the technology that can make LNG profitable on a small scale.
Okay.
So it's quite exciting because not only is it going to be first exports off Canada's coast, but it's also going to be using a slightly tweaked technology. You could call it a new technology in making LNG profitable on a small scale. So that should be very exciting for the country and really give us a good taste of how it's all going to go. So when the big projects come on stream, whether it's Exxon and Imperial or whether it's Shell and Mitsubishi or whether it's Malaysia's Petronas, any one of those three could come on, but not until sometime between 2018 and 2020.
Okay.
So we're going to get like a 3-year to 4-year window of seeing how it all works on a small scale before the big dogs really get their efforts producing.
Now, we're going to get into some specifics about what's going on with LNG and the export projects that are going on. But this kind of caught my attention in the Sun article. They were talking about BC's, quote, vast and largely untapped shale gas fields. Tell me a little bit more about what's going on there.
Well, one thing that I think is quite interesting is that we've got a situation where we are the back end of the gas market in North America. The consuming market is the U.S. East Coast, so we're obviously as far away from that as you can be and still be on the continent. So now we're going to have a complete turnaround where we're going to be the front guys because we've got a very short shipping distance to Asia. So all the LNG coming off North America, nobody's closer than us. So you've got assets like the Big Horn River Basin up near the Yukon border in British Columbia that is mostly dry gas. And so it doesn't have any liquids that improves the economics. So it's just been sitting there for the last 3 years. Huge reserves. And now, all of a sudden, it's going to have the market to be economic and go. So that's what people are talking about there. And, of course, there's also the Montney. The Montney asset is a wildly profitable gas asset that straddles the BC-Alberta border. But it has the benefit of having a lot of liquids, a lot of condensate, which is a very light oil, and other liquids like butane and propane, stuff that goes in your barbecue and your Bic lighters. So that improves the economics. So it is getting developed, but now it's really going to get developed with the LNG coming on stream.
Keith Schaefer from oilandgas-investments.com here on This Week in Money. We're talking about the big LNG news from the Exxon folks in the Vancouver Sun this morning. Premier Christy Clark saying that LNG will save our economy, Keith, generating between $4 and $9 billion annually. That's the good news, not the bad news. That's not going to happen for 7 or 8 years from now.
It's true, so let's hope they don't spend us into the ground before then.
Let's talk about the reality here. There's a dozen LNG projects, you're telling us, in the planning stages. Besides Exxon, a lot of the big names here, Apache, Chevron, Shell, PetroChina, British Gas, you mentioned Petronas, and the first LNG shipment now forecast to be sometime in 2015. Is that optimistic?
No, I don't think so. I think it's very realistic. In fact, I think there's a chance we could even beat that potentially, depending on how permitting goes here in the province. But basically now you've got each of these proposals except one already has an Asian buyer in the mix. So what's the big holdup right now, Phil, is everyone's waiting to see what kind of pricing these proposals can get for their gas on the Asian customer side. But obviously, Petronas is Malaysia's national oil company, so they've got their own proposal. You've got with Shell, you've got 3 Asian utilities or big producers there who would be buyers. So you're seeing already kind of built into the mix a buyer. So now what the market's waiting for is to say, okay, we're going to use this price. And as soon as somebody says, okay, we're going to use this price, whatever that is, I think you'll see just a huge step change in development. You'll see things speed up quite dramatically. Right now, everybody's kind of doing this little dance where obviously the producers want a big price and obviously the buyers want a small price. Yeah. So now they're just kind of, the whole game has been put on hold for about 6 months now while this dance kind of comes to a conclusion.
Keith, before we talk about the 4 LNG projects in detail, I want to slip in a plug here for your LNG investment conference. That's coming up September 25th in Vancouver. Tell us what's going on here.
Well, I've brought in so far 7 companies who I think could benefit greatly from the huge LNG build-out. We're talking about billions of dollars, tens of billions of dollars being spent in the next 2 or 3 years before a single molecule of gas goes off the coast. So I've got several service companies ranging from, $50 million market cap to over $1 billion market cap, and some gas-weighted producers who, if they were bought out on metrics where Exxon bought out Celtic or Petronas bought out Progress, these stocks would be double or triple their current price. So there's a lot of opportunity for investors. And on the retail side, it's just very difficult for them to get access to these management teams, and that's what I'm delivering at this conference.
Keith Schaefer from oilandgas-investments.com, our guest on This Week in Money. Keith, let's look now at our 4 main players up north in the LNG business, starting with the smallest, Douglas Channel. Tell me who these guys are and what's their plan.
Well, this is the one that really intrigues me the most. You've got a private equity group out of Texas who has a lot of experience with First Nations. So they've come in to help the Haisla First Nation be on board. And then you've got a group out of England called Golar, who are one of the largest LNG shippers. So they've basically put a group together called the BC LNG Cooperative. They're going to have a very small export facility, and they're using new technology to make that smallness be profitable. And they think they're going to be ready here within 2 years, and it's only going to be about 0.1 BCF a day, so 100 million cubic feet a day, which in the global scheme of things is very small. Mm-hmm. But this is the one I'm the most excited about, just because it doesn't need big infrastructure, and it's new technology, and it's going to give Canada a good first taste of how these ships will be coming in and off the coast. Okay,
let's talk about our number 2 player here, Kitimat LNG.
So this is with Chevron and Apache, and this is an interesting group just because it's one of the main projects that don't have an Asian buyer in the mix. And so Chevron has made it very clear that they are not going to move ahead with this unless they get oil-linked pricing. Right now, Phil, LNG trades about 13% the price of Brent, or 1/8, and a couple of the U.S. utilities have said that they want to do that on natural gas pricing. So Chevron has said if that happens and it's a lower price, we're not going to do it. So it'll be interesting to see how that one moves ahead over the next couple of years.
Okay, number 3, LNG Canada. Who are these guys and what are they doing?
Well, this is the big guys here. This is Shell. So Shell has done more for LNG around the world in the last few years than anybody else. They're kind of like the big global experts. So they brought in Korea Gas, PetroChina, and Mitsubishi.
Wow.
And they're just looking for really, they've got their National Energy Board approval. They've just started their environmental process, but they don't have a contracted buyer yet. So which obviously in my mind is going to be either Korea Gas, Mitsubishi, or PetroChina. So they just need to get that deal done. And then I think you're going to see an unbelievable pace of development begin there because they're the big guys.
Mm-hmm. Okay, let's look at number 4, Pacific Northwest LNG.
Right. So these guys here, that's Petronas and Japan Petroleum. So Petronas bought out the Canadian-listed Progress Energy for $6 billion last year to secure their reserve base, and now they're basically going full bore. They announced a $16 billion program here just last week, and I think they've got the ability to perhaps surprise everybody and be the next guys out of the gate. So it'll be very interesting to see how fast they move. And theirs is a pretty big facility. Theirs is the second largest. So they're about 2.5 Bs a day, billion cubic feet a day, compared to the Shell project, which is like maybe twice that size, 5 billion. So they're looking after their politics really well, and they're really showing that they want to move fast. So that they could be the dark horse in getting things done fast.
Keith Schaefer from oilandgas-investments.com, our guest here on This Week in Money. And the key question that you've already raised here, the money question, when is someone going to make a deal, and is it going to be a good price? Is it going to be a fair price?
Right. So what's happening right now is that the closest hint that we've got from the Golar team is that it's going to be just over $4, $4.25, $4.50 per million cubic feet, or per thousand cubic feet, per MCF. So that's, but that's just kind of like a trial balloon. So we'll see how that goes. That's a decent price, not a great price, but a decent price for producers, certainly for what they've been used to lately. And so, yeah, the next big step in this dance, Phil, is somebody announcing a firm price contract.
Certainly, good news. Looking forward for LNG, the International Energy Agency, Keith, this week saying the LNG market's going to jump 30% in the next 6 years.
Well, it just makes sense. It's such a clean burning fuel, and it's so abundant. And the infrastructure is being built now with a huge LNG shipping fleet to move it around the world quite inexpensively. So, and when you consider that LNG is condensed 600 to 1. So
wow.
You can pack a lot of gas in one of these boats.
From your Twitter feed, Keith, at Oil and Gas Invest, you're talking about Bill Power's new book, Cold, Hungry, and in the Dark, Exploding the Natural Gas Supply Myth. Tell me more about the book. What's going on here?
Well, I'm really excited for Bill. He is an amazing researcher. He's incredibly diligent and detail-oriented. And he's been saying for some time now that, look, the decline rate on these shale gas wells is so severe that, we're much closer to running out of gas than you might think. And so he's put all his research ability focused on this issue over the last 2 years and has this book out. So I've just ordered it from Amazon. I'm waiting for it to land here any day at my house, and I'm going to be very excited to kind of go through what the big points for him are. For anybody who's seriously interested in investing in natural gas, his book is a must. Okay,
Bill Powers. You can find out more information at Amazon.com or Amazon.ca or wherever you buy books. Keith Schaefer, our guest here on This Week in Money. Let's talk oil for a sec, Keith. Price of oil slipping and sliding to $94 in New York, down from almost $100 a barrel earlier in the weekend. Analysts talking about a lack of tightness in the physical market. That's keeping prices under pressure. What does that mean?
Well, really, it means that we're swimming in oil. So certainly here in North America we are. Internationally, it's a little bit of a different story. It's quite a bit tighter, though it certainly has got looser. And again, that's all because of the United States shale. So what's happened, Phil, is that because we don't import near as much oil as we used to, like the U.S. used to import, I think, 10 or 11 million barrels a day. That's down to 7 to 8 million barrels a day now. So there's 4 million barrels a day floating around. Most of that comes from West Africa. We've displaced a lot of oil from West Africa that now has to go find a home internationally. So because of the Iranian sanctions, that's actually not that big a deal, but the reality is that right now, on a strictly fundamental basis, there's looks like we're going to see lower oil prices because of looser supply. But of course, to counteract that, Phil, you've got all the geopolitical stuff going on, putting a bid under oil.
Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. He's online at oilandgas-investments.com. Don't forget the LNG Investment Conference, September 25th in Vancouver. Full details on the website. You can find Keith on Facebook. Search for Oil and Gas Invest. And, of course, don't forget Keith's Twitter feed. You want to stay up to date with what's going on at Oil and Gas Invest. Keith, it's always a pleasure, my friend. Thanks for talking to us.
Phil, God bless you.
Thanks to our guests, Martin Armstrong, John Rubino, and Keith Schaefer. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.